So if we remind ourselves what we're doing in Chapter 8 and 9, we're trying to evaluate projects. And we're using the concept of net present value. We need incremental cash flow, figure out what net present value is. So a couple of these problems that I'm going to do in Chapter 9 help us figure out what incremental cash flow is. Okay, and what I encourage you guys to do is, again, not shortcut these problems. The way that I lay them out, I create kind of a structure for you in Excel, kind of a template. I wouldn't shortcut them because it actually makes the problem a lot easier if you don't do that. So let's take a look at Chapter 9, number 1. We're going to go through that first. Let me make my screen a little bit bigger. Okay, so we have a company who sells 10 million computer chips a year at a price of $20 a chip. Okay, so sells computer chips, sells 10 million of them per year, and the price is $20 per chip. Okay. And I often take some of the data out of the problem because it, to me, makes it a little bit easier to work. So they're going to introduce a new chip. Okay. And what they expect is forecasted sales around 12 million. Per year, and they think that they can sell at a new price of $25 per chip. Okay. And then one of the other things that you guys will see me doing in these spreadsheets is I'm actually formatting the numbers, because for me, again, and I think it would be the same for you, it is helpful to distinguish unit values, because you guys are going to have to be calculating revenue and costs. Sometimes you're going to be given the per unit figures, and you'll have to do some calculations. So things that are in dollar values, I use a dollar sign. Things that are not, there's no dollar sign. So again, I think it's helpful to try to understand the problem. And then also with this new chip, the old is going to decrease in volume of sales. So it says it's going to fall to 3 million a year. Not 30. 3. And this is the new sales. So it goes from 10 million to 3 million. It's very typical when new products are released. That old chip has a cost to it of $6 a chip, and the cost of the new one is going to be $8 a chip. Okay. So we're asked the question, what is the proper cash flow to use to evaluate the new chip? So the idea that we would want to analyze, does this make sense? Right? So if I have this stellar pen and it generates a certain amount of cash flow each year, and then I introduce a new pen, the two of them together should be better than the one individually. And I just want to make sure the new one doesn't completely destroy the business. So if I'm focusing on the cash flow, that's my dominant concern. What I want to know first is the gross revenue from the new chip. So how do I figure out the gross revenue from the new chip? Yep. So we take the new chip, how many sales we're forecasting, we would take the new price, and we would multiply those two things together. And believe it or not, I actually want to emphasize for you guys to pay particular attention to this, because I see often problems trying to figure out what revenue is when you're given units and price. Okay, so this is the new revenue. Then I also want to figure out the cost of the new chip. All right, how do I figure out the cost of the new chip? Yep, so it's somewhat similar, except instead of using the price, I'm going to use the cost. And I'll get 96,000. So that is then able to, or gives me the ability to do the kind of cash flow from new chip. And I can subtract those two. 300 minus 96. Okay, now I have this old chip to think about. So I'm going to have to consider lost sales from old chip. So I go from 10,000 to 3,000, 10 million to 3 million. So that means that I've lost 7 million in sales. Right? So the old chip, originally we sold 10 million. Now we're only going to sell 3 million of it. And the price of the old chip is 20 bucks. So in terms of revenue, I'm going to lose $140 million. Or I'm going to no longer get $100 million. Then I'm going to have the cost from lost sales on the old chip, because I'm no longer going to incur those. So I'm going to have the same 7 million in sales. The old chip costs $6. So I'm no longer going to have to expend the $42 million. All right. So if I net those two numbers together, I essentially have lost cash flow from the old chip. So I have incremental cash flow from the new chip. I have lost cash flow from the old chip. And the total new cash flow then is the difference between those two numbers. 106 million. Okay? James. So originally, I had the 10 million. Now, I'm only going to have 3 million. Like so. Right?
Yeah.
Yep. No. I mean, that's the tricky part of some of this stuff, is you're trying to understand the data that's in front of you. And so in a project like this, we have something in existence that's being added, right? Added to. So it's kind of like if I had one really cool version of a bicycle and then I introduce a new bicycle model. Well, some people that were buying that old bicycle are going to buy the new bicycle. I'm still going to sell both of them, but I'm probably going to sell less of the first one. So what we have to do is we have to figure out what we're losing from the first bicycle and then add it to what we're gaining from the second new bicycle. And this is how we would do that. That's sort of the easiest way to lay it out. Okay? So the thing that I think is actually simple in this problem, but it's often overlooked, is kind of what the revenue calculation is. When you're given units and price, multiply the two of them to get revenue. The other is the cost. You're given units and cost, multiply them together. Okay? So that is question 9-1. All right? Any other questions about that? Right? And some of these things, what we're doing is we're laying out the pieces that you need to get to do the overall net present value calculation. Okay, so let's look at number 4. Okay. In this problem, we have a new project, and it's going to generate sales of 74 million. That's total sales, because it's got dollar values. And it will cost 42 million. It also has depreciation of 10 million. Okay. And we have a tax rate of 35%. Okay. When you guys are doing percentages, you can do it one of two ways, but if you format the number before you type it, format it as a percent, then you can type in the number 35. If you don't type it in as a percent, you need to do 0.35.
Can you just do 35 and the percent?
Does it work that way? I don't think it works that way. You'll get 350% or 30. It doesn't work that way. Yeah, does not work that way. And I mention that because I see errors when in the percentages. They get messed up, and then it messes up the whole number. Okay, so we want to know what cash flow for the year is. And we're not going to do it for all three methods. We're only going to do one method, which is the one that's the most important. So here's the method. So the first thing we're going to do is revenue less cash expenses. All right, and that will give us this new project minus the cost of it, and we'll add those two together like so. Okay. And then we're going to apply the tax rate. Or I should say not the tax rate, taxes. So I will take the 32 million times the tax rate. And then I will get after tax. Like so. So if I just take revenue minus the expenses and then I tax them, after tax I'm going to have 20,800,000. But that's not quite right because I have depreciation, right? So we don't want to forget depreciation. So what I'll actually do is add a couple rows, and I'll say less depreciation. Put in my depreciation. And I will get a subtotal, 32 million minus the 10 million. And then the tax is going to be the 22 million times, 22 million times 35%. And then 22 million, 22 million minus 7.7. Okay, now, this is not cash flow. This is profit. Okay? This is actually an income statement. Whoops. That is fantastic, but that's not our goal. Our goal is cash flow. So we have to do one thing to turn net profit or after-tax profit into cash flow. What we have to do is add depreciation. So I go back and I add the full amount of depreciation. And now, my cash flow, I take the 14,300 and I add the depreciation. And this gives me cash flow. Okay? So, the book, some examples, there's several different methodologies that it shows you to go through cash flow. For the most part, all that stuff is great. It's theoretically correct. But for ease of simplicity, I recommend doing cash flow this way. You basically get after-tax profit by building a just standard income statement. Revenue, less cash expenses, less depreciation, less taxes, gives you after-tax profit, and then you add back depreciation. And this is key. This is what makes cash flow different from profit. Because depreciation is not a cash expense, right? It's an accounting entry. So by adding back depreciation, we get cash flow. Okay? So to me, this is the simplest way to figure this out. Questions about that? Simple? Right? Okay. Let's do another one of these. Let's do Q9-5. And I'm going to let you guys do this on your own, and then we'll review it. So here's what I want you to do, because I think the problem is somewhat similar. So here's what I want you to do. Copy this whole, whatever you've typed, if you're working in Excel, copy the whole thing and paste it. Okay. And then delete out all the data, right? This creates a template for you. And then go into problem 9-5 and fill in the data. Fill this back in. And then see what the cash flow answer is that you get. We'll take 2 minutes to do that, maybe 3. Okay, what's the cash flow? What is it, James? 2.3 million. That sounds correct. Yep. 2.3 million. So it's identical to the same problem, right? So if we use the same structure, we're going to get the 2.3 million, okay? So we do the income statement, and then we add back depreciation. Everybody get 2.3 million? No? Where's it off, Anthony? One of the reasons why I use kind of the templates over and over, because I know that the formulas are right. It's also a little more efficient, okay? So we're going to do question 9.6. Actually, 9.6 and 7. They go mostly together. So the same thing. I would like for you to copy, if you're working this in Excel, copy the whole thing again. Bless you. And then delete out what's in the green, like so. And then let's look at number 6, and I'll do this up here so you can follow. The owner of the bicycle shop is forecasting revenues of $160,000 per year. So, $160,000 per year. The variable costs will be $50,000, and the rental costs for the shop are $30,000. So there's two cost elements. One is $50,000, and then the other is $30,000. So I'm going to add them together. And this is the variable cost plus the shop rental cost. Okay, those go together. And the depreciation is $10,000. And the tax rate is 0.35. So this problem 6, wants to know what the income statement is. So this part is the income statement, all the way down to after-tax profit. Then part 7 wants to know what the cash flow is. And we can do all three methods, quite honestly. We don't need to. We're just doing one method to get cash flow. Yeah. Yeah. These problems are so simple that doing all three methods, I do not feel it is a good use of time. I would rather have you concentrate on one method and get it right than three methods and be slightly confused. Okay? Now, if I was doing my P&L a little bit more substantially, I would do revenue less variable cost to get gross margin, and then less rental costs to get something, we'll call it operating margin, less depreciation, actually, take out the operating margin. we'll just do less depreciation. We'll put operating margin here, less taxes. And that would give us net profit. Okay. This is a slightly more detailed income statement. Okay. And sometimes you will need to do that. Sometimes you can do a shortcut. Okay. And generally, exams, if I give you a lot more data, you're going to find that actually having that more detailed income statement is going to be beneficial. Okay, so that's number 6 and number 7. Let's do one last of these, number 8. And I will let you guys do this on your own. And then we'll compare. So same thing, kind of copy that. And take 2 or 3 minutes, do number 8. And we're going to do a slightly bigger problem before we wrap up. Okay, what do we have for the cash flow? It's got the number. That sounds right. Yep. 56,250. Okay, so these 1, 2, 3, 4, 5 problems are all about calculating cash flow. You're given an income statement, calculate cash flow. If you remember a couple of foundational things, don't forget taxes, add back depreciation. That will get you to cash flow. Okay? Okay. The next problem that I want to do is number 14. Okay, so we're going to evaluate a project. The company needs a new lathe. I'm not sure what a lathe does, but it's some type of piece of equipment, manufacturing. I don't know if it like punches.
Like really fast, so that you can like, yeah, so you can work it like an instrument of like bell curve, or maybe we'll spin it out.
Okay.
Or if you're working with wood, you can like drag a piece on it and like create textures.
Nice. So like a spindle.
Yes.
For my stairway. Excellent. Thank you. It's great that somebody knows that. It's always helpful. Okay, so it can buy a new high-speed lathe for $1 million. It's going to cost $35,000 a year to run that lathe, but it will save the firm $125,000 a year in labor cost, and it will be useful for 10 years. Okay, so let me record that information. So, the new high-speed lathe. It has $1 million of one-time cost, and then each year, $35,000 annual cost to run it. Okay, those are two separate things, and we want to keep them distinct because we're going to analyze them in different places. Then we are going to save $125,000 per year. It doesn't say that, but because it's behind the per year, I'm going to assume it's per year. Right? Some of the problems, sometimes they're a little bit vague, but generally when you have savings for a project, it should be per year. Now, it could be one time, but I'm going to interpret the problem as per year. And also, that's what's in the solution that I use. Haha. But if it's when I write questions, I make that clear. If it's unclear to you guys in the problem, I would ask. But generally, it's the way that it's sequenced in the problem, I would assume it's per year. It has a 10-year useful life. I need this for the depreciation. And not $10, it's 10 years. And it will have a $100,000 salvage value at the end, which is kind of what I could sell it for in a garage sale. That's how to think about salvage value. And that's $100,000. And then it tells me that it will also have a $100,000 market value in year 10. We have a 0.088% discount rate and a tax rate of 35%. Okay. Okay, so I think I have everything in the problem, right? So this has a little bit more information than those prior problems that we calculated cash flow. But we're going to do some similar things with this information. But the first thing I'm going to do is I'm going to set up a template, if you will, to analyze this. So I'm going to do two things. I'm going to identify the time horizon. Okay, one step is to identify the time horizon, and I'm going to start with year 0, and I'm going to go all the way to year 10, right? And if I'm fancy, I'll just do this, and then I'll replace the 4s. Eight, 9, and 10. Okay, now I also want to put a numerical value under the years because that is a text value. Because I'm going to use those numerical values when I calculate the present value. Okay. Now, the first thing that I'm going to identify is the cash flow in. That is going to come from one of two places. It's going to come from revenue or it's going to come from savings. So when we're evaluating a project, we have cash flow in, and the project is either going to generate some type of revenue or some type of savings, right? This is money that you're going to put back in your wallet. And that revenue savings is going to recur over the life of the project. So in this project, do we have incremental revenue? No. Do we have incremental savings? Savings. So starting in year 1, I'm going to incorporate the savings. Okay, 125000. Now, to make my life easy, because that savings is consistent over the 10 years, I'm going to do an equals and a cell reference to that row. And then I'm just going to copy that formula all the way across. Okay, so this is the top part of the income statement. I'm just labeling it the cash flow in. The next thing I'm going to include then is the cash flow out. And I'm going to include the one-time. I'm going to include annual costs and include depreciation, because I happen to know that in this problem I have those things from reading it and summarizing the information above. So, one-time costs often happen in year 0. That's the present, right? That's today. So I'm not going to get any of the savings from this lathe until it's fully installed and up and running. But I'm going to have to pay for it today. So I am going to, as a one-time cost, include the purchase price of the lathe, and I'm going to include it as a negative value because I have to spend that money. So it's going to be negative $1 million. Now, I am also going to have the annual cost to operate that lathe. So it's going to cost me $35,000 a year to run the lathe. And I'm going to put that in as a negative value because it's an expenditure. And the same thing like I did with the 125. I'm going to do an equals to that cell, and then I'm going to copy it out all the way to the right. This way I don't have to type things 8 or 9 times. Okay, now I know that I also need to include the depreciation. Question is how much? So what a lot of times I like to do up in another area of the spreadsheet is I like to calculate the depreciation. Just because it helps me. I don't like to shortcut things. So the cost of the lathe is $1 million. The salvage value is $100,000. That gives me the depreciable, I think that's a word, depreciable cost, which is the difference between the cost and the salvage value, 900. Its useful life, they told us, is 10 years. So based on the rules of straight line depreciation, I'm going to take the depreciable cost of 900 divided by 10, and that tells me that every year I'm going to depreciate $90,000. So then what I can do is go down to my cash flow out, include the negative 90,000. Now, I'm building the P&L. Even though this is in a little section called cash flow out, I'm going to include the depreciation even though it's not a cash expense because I'm going to add it back in at the bottom. Okay? And then just like I did above, we'll copy that 90,000 to the remaining years. Okay, now, the only other thing that I have to think about is the lathe, and it's going to be worth $100,000 at the end of its life. It's a little bit vague the way that it's stated in the problem, but because that lathe is worth $100,000 by year 10, I could probably sell it. I could just, take it out of my factory and I can sell it for $100,000. So, what I want to do is I want to figure out how much cash flow I'm going to get from selling the lathe. So, what is the selling price? It's probably going to be the $100,000 market value. Then I look at the book, we call it the book value, at the time of the sale. Well, this is in year 10. So we've depreciated down the lathe, $90,000 a year for 10 years. So 10 times 90,000. So we have depreciated away 90,000. Well, it cost us a million, so that means that its book value is 100,000. Yep. Let me pull it up here. So each year we depreciate the 90,000. We've depreciated it for 10 years. So 90 times 10 is 900. So we paid $1 million for it. So if I take the $1 million versus the 900,000, its value at the sale, or its book value, is 100. Okay. If I was selling this in year 8, and maybe this is a nice comparison to see why this is important. If I was selling this in year 8, I would have only depreciated $720,000. So I bought it for $1 million. At that point in year 8, it's worth $720. Or I'm sorry, I've depreciated $720,000. So its book value would be $280. So each year, the value of the lathe decreases by $90,000. So after 10 years, its book value is 100. Then, why in the world do I need to worry about that? Well, I need to calculate the gain or the loss on the sale at that time. When I do this garage sale, if the selling price is greater than book value, I have a gain. If the selling price is less than the book value, I have a loss. So in this situation, it's neutral. But the reason why this is important is because if I have a gain or a loss, I have to pay tax. And that tax reduces my cash from the sale. So I would take the selling price less the tax. And that gives me the cash on the sale. So if at the end of year 10 I sold this for $250,000, I'd have a $150,000 gain. I'd have to pay $52,000 in tax on the gain, right? So the tax is on the gain, right? And then the cash on the sale is the selling price less the tax. This is a little mini analysis that I have to do. Okay, well, I didn't sell it for $250. I sold it for $100. And what that means is in year 10, I'm going to have a one-time amount of that $100,000 as cash. Okay? Okay, so you guys can finish working on this. I will post the solution in Moodle, and you can check what you put together. For your activities for the rest of this week, so Friday will be a working day for your 2 assignments. One is your Chicago neighborhood project and finishing the research. And then there's a few homework problems. Okay? So we'll be back together on Monday with a review of all of Chapter 8 and 9. Okay, great. So the next thing that we're going to do to finalize our analysis is to calculate the overall cash flow for each year for the project. So in order to do that, I'm going to make a couple of modifications to my spreadsheet at this point. So one of the things I'm going to do is move these one-time costs just a couple of rows below. And I want to do that because what I need to be able to do based on the revenue and expenses for this project is I need to be able to calculate the after-tax profit. So I'm going to put in this subtotal before tax profit, and then what I'm going to do is add up the revenue and the expenses. This will give me before tax profit. Now, as you can see, this is 0. In some projects it won't be. What I would then do is I would apply the tax rate. So I would take that before tax profit, multiply it times the tax rate, hold the cells constant. So by putting a $sign in front of the D and a $sign in front of the 13, I'm going to hold the tax rate cell constant. I'm going to copy that across, and then I will have another subtotal, which is after-tax profit. And what I will then do is calculate before tax profit minus taxes to give me after-tax profit. Now, this may seem silly because we have no profit, but I want you to see the methodology. Okay. Now, what I want to do with that after-tax profit is I want to add depreciation, and this is going to give me cash flow. So what I will do is I'm going to get the value for depreciation. What I've done is I've taken negative times the cell value for depreciation because I want to add that number to my after-tax profit. I will carry that formula all the way across. And I will add after-tax profit plus depreciation. And then that's going to give me that view of cash flow. And then the final thing that I will do is add in the one-time elements. So we will call this total cash flow. And we will include the one-time elements. I will summarize that all the way across. Okay. Now what I can do is take the present value of the cash flow by using the PV equation. And I'm going to use the discount rate of 8%. And again, let me get my formula correct. I'm going to use 8%. The period, I'm going to use the value 0. And then in the future value, I'm going to put the total cash flow. So getting those cell references correct is really important. And then the only adjustment that I'm going to make is to my formula up here. I'm going to put a negative sign in it because whatever the sign is for this total cash flow, I want it to be the same for the present value. And then I'm also going to put a dollar sign in front of the column and the row that hold the discount rate so that when I copy the formula across, it will hold that. So I'm going to copy all of that across. So now I have the present value of all my cash flows, and that will allow me to determine the NPV, and that is going to be the sum of all of these cash flows. And when you do this calculation, you should get a negative value. If you haven't gotten a negative value, you probably have some type of an error. So the NPV is the summation of the green line. So for this particular project, to purchase this lathe, what we would include is that NPV is less than 0, thus do not pursue the project. This is not a positive NPV project.